If you've been waiting for a sign that the market is about to explode, this is it. Tom Lee, the head of research at Fundstrat, just dropped a bold prediction on CNBC. $7 trillion in cash is about to get deployed into the market. That's right, $7 trillion currently sitting on the sidelines could soon flood into equities, and if he's right, this could be one of the biggest buying opportunities we've seen in years. According to Lee, the Federal Reserve is expected to shift to a more dovish stance next year. That means interest rate cuts could be back on the table, and when that happens, he says PE ratios will start climbing. In simple terms, stocks could start getting revalued higher, fast. This is a setup we don't see often. Low valuations, tons of cash waiting to be deployed, and a potential pivot from the Fed. Combine all of that, and what you've got is rocket fuel for the stock market. 𝗗𝗟𝗡𝗧, vice chairman of Ariel Investments, joined the conversation and agreed that current market conditions are pointing toward a recovery. Both experts acknowledged the risks, like inflation and the government's growing budget deficit, but the near-term outlook, it's bullish. In a moment, I'll show you the exact clip from CNBC so you can hear Tom Lee's full breakdown for yourself. After that, I'll give you my own reaction and analysis. Along with two powerful growth stocks I believe are perfectly positioned to ride this coming wave of capital and make you millions of dollars. This stock has massive upside potential, and if you're serious about making life-changing gains from this market setup, you'll want to pay close attention. So if you only watch one video today, make sure it's this one, and stay with me all the way to the end. Go ahead and hit that like button. Let's see if we can hit 1,000 likes on this video. Share it with anyone you know who's sitting on the sidelines right now, and drop a comment below with your thoughts. Don't forget to subscribe so you never miss the next big move. Alright, let's roll the clip of Tom Lee.
Tom, security stocks have been on a nice run in general, but as we see Okta sort of pulling in the full year revenue guidance here, even though the results themselves look pretty strong, Tom, that in also the context of Salesforce doing this attempted buy of Informatica, is this environment more bullish or is it not with the macro uncertainty?
Well, I mean, companies should understandably be cautious because, you know, the tariff drama is still in play. I think investors are ultimately going to give pass to companies that don't give guidance. I mean, I don't think Okta's sort of pulling guidance means actually there's a downturn coming. It's just, I don't know how anyone could actually say what they expect for the next 2 quarters. But that being said, I do think 2026 is shaping up to be pretty good. So I not only do I think it's a good M&A environment next year, but we'll have deregulation, we'll have some visibility on taxes. I think the tariff drama is behind us, and the Fed, who's been on hold, is probably going to be dovish next year. I mean, to me, all of that means PE should be going up, and I think the $7 trillion of cash on the sidelines starts to get deployed.
Okay. Charlie, we've still got rates higher for at least for now, probably for longer than a lot of people would like. And we've got a consumer that's overall getting pinched on the credit side. We'll see how overextended. Now, I know you like value, but value gets affected by those things. No? How should investors navigate that?
Yeah, a couple of thoughts there. One, it is true that higher interest rates actually have less effect on value than on growth because value stocks have a shorter duration. Their cash flows are coming sooner than growth companies whose cash flows are in the far distant. So higher interest rates, all else equal, have less effect on value stocks than on growth stocks, the low PE versus high PE. But you're absolutely right. One of the real bear cases on value is the consumer. Today's news was very positive for the consumer confidence, but all of us who are talking to companies are still worried about the consumer, and I will admit that is more of a headwind for value stocks than for growth.
Tom, Bitcoin at around 110,000 right now, at very high levels, and you think that that's bullish for growth and risk overall?
Yeah, I mean, Bitcoin for the past 10 years has been not only a leading indicator, but I think a risk-on indicator because it does respond to liquidity. So Bitcoin made an all-time high last week. Bitcoin peaked a month before the S&P did. So I do think this is telling us the S&P should be making all-time highs pretty soon. But it doesn't mean I think Bitcoin's capped as well. I mean, I think we have to keep in mind that institutional adoption for Bitcoin's growing. I think that consumer awareness for Bitcoin actually is still pretty nascent. And so when we still have a visible demand coming and a fixed supply, I think it's a lot of upside for Bitcoin.
Alright, so let's break down what Tom Lee just said, because there's a lot to unpack here. And honestly, some of his insights could have big implications for how we all think about the market right now. Let's start with his take on the US budget deficit and the bond market, because this is a critical issue that's often glossed over. Tom's not mincing words here. He's saying flat out that the level of debt and deficit the US is running right now is unsustainable. He literally uses the phrase, "what can't go on forever, ends," which is a sobering reminder that at some point, there's going to be a reckoning. Now, he acknowledges that it's difficult to time when this kind of fiscal stress shows up in the markets, and he's right. We've seen markets rally in the face of rising debt for years, but eventually these deficits will become inflationary, especially if the Fed steps in and starts buying that debt, which, as we all know, essentially means printing money. And on top of that, you've got tariffs, which are also inflationary by nature. So, what's the takeaway? In the long run, this macro environment is setting up to be inflationary. And that affects everything: interest rates, bond yields, equity valuations, even the housing market. If you're a long-term investor, this is the kind of thing you want to be aware of now, not when the Fed is forced to act reactively. Next up, Tom gives his take on the tech space, particularly in light of some big moves like Salesforce trying to acquire Informatica, and Okta pulling back on revenue guidance. Now this is where Tom's optimism really comes through. He doesn't think these cautious moves are signals of a downturn. Instead, he says companies are simply being careful because the macro outlook, tariffs, interest rates, global trade tensions, it's still murky. And this is key. He thinks investors will actually give companies a pass for not providing full guidance in this environment. That's a big deal. It suggests there's still confidence in the fundamentals of these companies and that this is more of a sentiment-driven pause than an actual earnings cliff. And here's where things get even more interesting. Tom is looking ahead to 2026 already. That's right, not 2024, not 2025, but 2026. He thinks that by then we'll be in a very bullish setup. Potential deregulation, clarity on tax policy, tariff issues resolved, and, importantly, a dovish Fed. Put all of that together and you're looking at an environment where PE ratios should expand, and a lot of that $7 trillion in cash sitting on the sidelines could come pouring back into the market. That's massive. If that prediction holds, we could see a major rotation back into equities in the next 18-24 months. Now, when the hosts bring up interest rates staying higher for longer, and how that might pinch the consumer, Tom gives us a very nuanced take on value versus growth stocks. He reminds us that value stocks are less sensitive to rising interest rates because their cash flows are front-loaded. In other words, they don't rely on some big future payoff 10 years down the road. They generate real cash now. So higher rates? Less of a headwind for value than for high-growth tech plays? But, and this is important, he doesn't deny the real risk. The consumer's under pressure, especially on the credit side. Yes, we got some good news recently with a bump in consumer confidence, but if you're talking to CEOs, to small business owners, even just looking at household debt loads, there are cracks forming. And Tom admits that this could pose a real headwind for value stocks, more so than for growth. So again, nuanced. He's bullish, but he's not blind to the challenges. Now let's talk Bitcoin, because this part of the interview might surprise some of you. Tom brings up that Bitcoin, which recently hit around $110,000, is not just some speculative play anymore. He actually calls it a leading indicator, and a risk-on signal that reacts to liquidity. In plain English, when money starts flowing again, Bitcoin is one of the first places it shows up. And he makes a great point. Bitcoin peaked before the S&P 500 last time, and now that Bitcoin is making new all-time highs again, it could be a sign that the broader stock market is about to follow suit. Even more interesting, he says institutional adoption of Bitcoin is still accelerating, and consumer awareness is still in its early stages. Think about that. If most retail investors still haven't jumped in and the big money is just starting to come in, there could be a massive second wave of demand on the horizon. Whether or not you're into crypto, it's something to watch, because Bitcoin is increasingly becoming a proxy for risk appetite across the financial system. So to sum it up, Tom Lee is seeing a long-term bullish case for the markets. Yes, there are short-term challenges: consumer strain, unclear macro policies, elevated rates, but the setup he sees for the next 2 years, deregulation, reduced tariffs, more Fed flexibility, and cash flowing back into the market. His key message? Don't panic. In fact, he's saying that this is the time to be buying the dip, not running for the hills. And that one quote from earlier really sticks with me. He's talking about the debt, the deficits, the unsustainable pressure. And eventually, the market is going to force a reset. That's when the biggest opportunities emerge. So if you're building your portfolio or trying to decide whether to stay in this market or sit on the sidelines, take this as a signal. There's still real opportunity ahead. You just need to be smart, be patient, and stay informed. And speaking of opportunity, in the next part of this video, I'm going to share with you one stock that I believe perfectly fits into the macro thesis Tom just outlined. It's undervalued, has strong fundamentals, and is well positioned for the next bull cycle. So don't go anywhere. Hit that like button if you haven't already, drop a comment below with your take on Tom Lee's analysis, and subscribe if you're serious about navigating the markets with confidence. Alright, let's move on with our first contender for the 2 growth stocks that'll make you millions. A company that's truly shaking up an industry many thought was set in its ways. I'm talking about Oddity Tech, trading under the ticker ODDID. Oddity is flipping the traditional beauty and wellness concept on its head, using technology and data in ways that are frankly genius, creating a personalized experience that customers are absolutely flocking to. They're not just selling makeup or skincare, they're selling a data-driven, tailored solution. Imagine a beauty company that uses artificial intelligence, sophisticated algorithms, and massive data sets to understand your unique needs, preferences, and even your skin's characteristics without you ever stepping foot in a store. That's the core of Oddity's innovative approach. They've built powerful online platforms, most notably for their flagship brands, 𝗗𝗚𝗦𝗗𝗑𝗧 and �11𝗚𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏 quiz on a website, we're talking deep learning models that analyze everything from user-provided information to visual data, helping to recommend products with an astonishing level of accuracy. This focus on AI-powered personalization is what sets them apart from the old guard of the beauty industry. Their direct-to-consumer (DTC) model is another key pillar of their strategy. By cutting out the middleman, Oddity maintains full control over the customer experience from initial discovery to post-purchase engagement. This not only enhances brand loyalty, but also provides them with an unfiltered stream of valuable customer data, creating a powerful feedback loop that continuously refines their AI models and product development. 𝗗𝗟𝗦𝗗𝗧, their premier makeup brand, is a testament to this strategy's success. They've built a cult following by offering high-quality products combined with an unparalleled online matching experience, particularly for foundational products which are notoriously difficult to buy online. Their Power Match quiz, for instance, uses AI to help customers find their perfect foundation shade with remarkable accuracy, tackling a major pain point for online beauty shoppers. Then there's Spoiled Child, their wellness and skincare brand, which also leverages this tech-centric approach. It focuses on personalized anti-aging solutions, again using AI to recommend specific routines and products based on individual concerns and goals. This expansion beyond color cosmetics into the broader wellness market demonstrates Oddity's ambition and the scalability of their underlying technology platform. The market leadership Oddity has achieved in its specific niches is remarkable, especially considering the relatively short time they've been making waves. They've demonstrated an ability to rapidly acquire customers and build strong brand recognition in a crowded marketplace. Their digital marketing prowess is a huge part of this, efficiently targeting and converting consumers online, where they are increasingly spending their time and money. The repeat purchase rates and customer loyalty metrics for brands like 𝗗𝗟𝗦𝗗𝗧 suggest that the products themselves deliver on their promises, and the personalized experience keeps customers coming back. This combination of effective customer acquisition and strong retention is a powerful engine for sustainable growth, something we always look for. This is a company with a current market cap of $4.17 billion. Its earnings per share sit at $1.87, and it's trading at a price-to-earnings ratio of 39.80. For 2024, Oddity pulled in revenue of about $647.04 million, with a net income of $101.49 million. But here's the interesting part. Its current stock price of $74.43 is sitting 87.4% below its estimated fair value price of $139.48. That suggests there might be a lot of room for growth if market sentiment and fundamentals align. Recently, Oddity has been on an upward trend in its stock performance. We haven't seen any major news headlines driving this movement, but the momentum is clearly there. This kind of price action usually signals growing investor confidence, even in the absence of specific announcements. It's definitely a stock worth keeping an eye on as broader market conditions and possible news developments come into play in the coming weeks. So, what about the potential for future growth for OD? Well, it's immense. Firstly, there's the continued penetration of their existing markets. While they've made significant inroads, the global beauty and wellness market is colossal, and there's still a vast runway for them to capture more share, particularly as more consumers shift their purchasing habits online. Secondly, international expansion is a major growth lever. Their model is inherently scalable across geographies, and they've already begun to make moves into new international markets. Imagine the power of their AI platform when applied to diverse populations with unique beauty standards and preferences. The data they gather will only make their global offerings stronger. Thirdly, the potential for new brand development and product category expansion is significant. Oddity has proven its ability to build successful brands from the ground up, leveraging its tech and data infrastructure. There's no reason they couldn't apply this playbook to other segments within the beauty and wellness landscape, or even adjacent categories, further diversifying their revenue streams. The leadership team at Oddity also seems to have a clear vision and a strong track record of execution. Their ability to identify market gaps and build technology-driven solutions has been impressive. Oddity Tech presents a compelling case as a growth stock with significant upside potential. Now let's shift gears from beauty to the backbone of modern digital infrastructure security. Our second growth stock spotlight is on Okta, trading under the ticker Okta. In an era where our lives and businesses are increasingly migrating to the cloud and online platforms, the question of who are you, and what are you allowed to access, has never been more critical. Okta is a pioneer and a dominant force in answering these questions. Okta is a leader in identity and access management, or IAM. Essentially, they provide the tools that organizations use to manage and secure user authentication into modern applications, websites, and devices. Think about all the different software, cloud services, and internal systems an employee at a large company needs to access. Okta streamlines this with solutions like Single Sign-On, SSO, allowing users to log in once and gain access to multiple applications. Their pioneering role stems from recognizing early on that as companies moved away from traditional on-premise IT environments to a more distributed cloud-based world, the old ways of managing identity wouldn't cut it. The network perimeter was dissolving and identity became the new security control plane. Okta stepped in to solve this complex challenge, building a cloud-native platform from the ground up. This foresight has positioned them as an indispensable partner for thousands of organizations worldwide, ranging from small businesses to the largest global enterprises. They help companies securely connect the right people to the right technologies at the right time. This isn't just a convenience, it's a fundamental security requirement in today's threat landscape. One of Okta's core strengths is its vendor-neutral approach. The Okta Integration Network boasts thousands of pre-built integrations with a vast array of applications, whether they are cloud-based, SaaS applications, on-premise systems, or mobile apps. This makes it incredibly easy for organizations to connect all their disparate technologies into a unified identity management system, a huge selling point. Beyond SSO, multi-factor authentication is another critical area where Okta excels. MFA adds an extra layer of security by requiring users to provide 2 or more verification factors to gain access to a resource, significantly reducing the risk of unauthorized access due to compromised credentials. In a world rife with phishing attacks and data breaches, MFA is no longer a luxury, but a necessity. Okta's dominance in the IAM market is well established. They consistently rank as a leader in industry analyst reports, and their impressive roster of customers speaks volumes about the trust and value they deliver. This market leadership creates a powerful network effect. The more customers and applications that use Okta, the more valuable the platform becomes for everyone. The company has also been smart about expanding its platform capabilities. They've moved beyond just workforce identity, managing employee access, into customer identity and access management, CIAM. CIAM solutions help businesses provide secure and seamless login experiences for their customers, which is crucial for building trust and driving engagement in consumer-facing applications. Think about the online retailers, banks, or healthcare portals you use. Many of them are leveraging CIAM solutions like Okta's to manage your identity, ensure your data is protected, and provide a smooth user experience. This significantly expands Okta's total addressable market, as the number of customer identities far outweighs the number of employee identities globally. With a market cap of $17.74 billion, the company posted earnings per share of 6 cents and carries a sky-high PE ratio of 1,719.50. For 2024, Okta reported revenue of $2.61 billion and a net income of $28 million. Despite that lofty valuation, what's encouraging here is the trend. They're showing signs of improving financial health. Revenue is on the rise and they've swung back into profitability, which is a positive signal for investors who are looking at growth potential down the line. Even though the numbers suggest Okta is still in the early phases of turning things around, especially in terms of profitability, the progress is undeniable. It's another example of a tech company navigating a complex, macroeconomic landscape while moving in the right direction. Looking at future prospects, Okta is incredibly well positioned for continued growth. The digital transformation trend is far from over. More workloads are moving to the cloud, more applications are being developed, and remote work is becoming more prevalent. All of these trends increase the complexity of managing identities and access, driving greater demand for solutions like Okta's. When you consider the critical nature of identity in the digital age, Okta's market leadership, its comprehensive platform, the strong secular tailwinds, and its multiple avenues for future growth, Okta stands out as a compelling long-term investment in the cybersecurity space. It's essentially providing the digital keys to the kingdom for countless organizations. So, there you have it. Two growth stocks, Oddity Tech and Okta, each with incredible potential to disrupt their industries and deliver significant returns for savvy investors. We've seen how Oddity is using AI to redefine beauty and wellness, and how Okta is the gatekeeper of our digital lives. These are powerful narratives backed by solid innovation. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. See you in the one.